Imagine California, the land of golden dreams, unraveling before our eyes. Once mighty housing markets are buckling under the weight of soaring mortgage rates, vanishing buyers, and price cuts so steep they feel like freefall. In 2025, families are watching $1.5 million homes sink by $300,000 overnight, while monthly payments rocket past $8,000, crushing even six-figure earners. Streets once lined with open house balloons are now graveyards of unsold listings. From Silicon Valley's tech palaces to Orange County's gated estates, the California dream is collapsing into a nightmare. These 10 cities reveal the brutal truth. The crash isn't coming. It's already here. Number 10. Placentia. Placentia might look like a sleepy suburban escape in Orange County, but in 2025, it's quietly becoming one of California's most dangerous housing traps. On the surface, the numbers appear calm. A median home price hovering around $850,000, and tidy neighborhoods lined with stucco homes and manicured lawns. But here's the ugly undercurrent. Buyers have dried up. Listings are piling up faster than sellers can slash their prices. Active inventory is up nearly 40% year over year, while pending sales have fallen off a cliff. Homes that once went pending in 2 weeks now linger for 60 to 90 days, and desperate sellers are resorting to brutal price cuts. Nearly 28% of listings in Placentia have had reductions, many slashing $50,000 to $100,000 just to attract a single offer. The affordability crisis is tearing this city apart. The average household income in Placentia is about $105,000, but with today's mortgage rates around 7%. Buying that $850,000 house requires an annual income north of $175,000. The math doesn't work, and buyers know it. Monthly payments that once sat at $3,500 now punch past $5,200, not even counting $9,000 annual property taxes and soaring $2,500 insurance premiums. For families, that means shelling out $7,000 plus per month just to hold the keys to an ordinary tract home. Meanwhile, investors are fleeing. Rental yields have collapsed as rents stagnate around $3,200, meaning landlords are bleeding cash if they bought in the last 2 years. With rates locked high and insurance companies pulling out of fire-prone parts of Orange County, the once safe suburban bet is turning toxic. The terrifying part? If prices fall even 15 to 20%, thousands of families who bought at peak 2022 prices will be underwater. Placentia isn't just cooling, it's a suburban meltdown in slow motion, with the first cracks already visible in every for sale sign that lingers far too long on quiet cul-de-sacs. Number 9. Westminster. Westminster, tucked in the heart of Orange County, was once a magnet for steady middle-class buyers and investors betting on a strong suburban core. But in 2025, the numbers scream collapse. Median home prices hover around $870,000, yet the reality is they're sliding month after month. A home that sold for $950,000 in 2022 is now struggling to fetch $820,000, and the bleeding hasn't stopped. Nearly 1 in 3 listings are being hit with price cuts, some slashing $75,000 to $150,000 in just 3 months. Days on market have doubled to 65-plus days, leaving streets lined with for sale signs that feel like tombstones of the housing dream. The affordability math here is brutal. Average household income in Westminster is just $95,000, yet mortgage payments on the median home with a 7% rate now demand more than $5,400 per month, plus $9,500 in annual property taxes and $2,700 in insurance. Families need close to $180,000 in income just to qualify, but that kind of paycheck doesn't exist for the majority of locals. The gap between wages and housing costs has become a canyon, and buyers are refusing to play ball. The investor scene is just as grim. Rents have flatlined near $3,100 per month, meaning landlords who bought recently are hemorrhaging thousands each year. Investors who banked on appreciation are now staring at losses instead. Add in a 30% jump in inventory, and Westminster's housing pipeline is overflowing with unsold homes nobody can afford. The most shocking signal? New construction projects are halting, with developers shelving subdivisions mid-frame because buyers simply aren't lining up. What once looked like Orange County's reliable growth corridor is turning into a nightmare of vanishing demand and ballooning carrying costs. Westminster isn't softening, it's unraveling, one desperate price cut at a time. Number 8. Mission Viejo. Mission Viejo, the picture-perfect master-planned community in Orange County, is unraveling beneath its palm-lined streets. Median home prices still hover around $1.05 million, but behind that glossy number is a housing market cracking under its own weight. Sellers who once bragged about all-cash bidding wars are now watching buyers vanish, leaving them slashing $100,000 to $200,000 off asking prices. Nearly 35% of listings are seeing reductions, and properties that sold in 10 days in 2021 now sit unsold for 80 to 100 days. Affordability has hit a breaking point. The average household income in Mission Viejo is $128,000, yet the monthly cost of owning a $1.05 million home at 7% interest has skyrocketed to $6,600. Add $11,000 property taxes, $3,000 in insurance, and often $400 HOA dues, and families are staring at bills topping $7,600 per month. That's almost 70% of the local median income, a crushing ratio that pushes buyers to the sidelines. Investors are panicking too. With rents stagnating around $3,400 per month, rental yields have collapsed. Landlords who bought in 2021 to 2022 are hemorrhaging cash, and many are listing properties they can't afford to hold. Inventory has ballooned 45% year over year, giving buyers far more power than sellers want to admit. Worse, rising wildfire insurance premiums are hitting this hillside city hard. Insurers are either pulling out or doubling premiums for homes in higher-risk zones, leaving families trapped between massive bills and evaporating resale value. Mission Viejo's housing dream is collapsing into a debt trap. The very city that symbolized planned suburban success is now flashing red warning lights. Too expensive, too leveraged, and teetering on the edge of a painful correction. Number 7. San Ramon. San Ramon, long celebrated as a tech commuter haven in Contra Costa County, is spiraling into one of Northern California's nastiest housing shocks. With a median home price near $1.35 million, the city once rode the Bay Area tech boom straight into the stratosphere. But in 2025, that same dependence is dragging it into the abyss. Tech layoffs across Silicon Valley have gutted demand. The same executives who were bidding $200,000 over asking in 2021 are now sitting on the sidelines or fleeing the state altogether. The numbers are jaw-dropping. Median home prices are already down 12% from their 2022 peak, with recent comps showing once $1.5 million properties closing at $1.3 million or less. Inventory is up 50% year over year, flooding the market with options. Nearly 40% of homes have price cuts averaging $150,000, and the average days on market has spiked to 75 days, triple what it was 2 years ago. Affordability is outright impossible. The average household income in San Ramon is a lofty $160,000, yet at today's rates, a $1.35 million mortgage carries payments of $8,200 per month. Add $14,000 in property taxes, $3,500 insurance premiums, and HOA dues in some developments, and families are staring at $9,500 plus monthly bills. Even with high incomes, it's a crushing load. The rental market offers no lifeline. Average rents hover around $3,700 per month, leaving investors deep in the red. Meanwhile, rising office vacancies in nearby San Francisco are weakening commuter demand, stripping away one of San Ramon's selling points. Developers are stalling projects, and sellers are panicking as homes sit unsold in upscale subdivisions. San Ramon's housing market is unraveling under the weight of high costs, tech industry weakness, and unsustainable debt. The city once seen as a safe bet for Bay Area families is now flashing red as one of California's most shocking freefall stories of 2025. Number 6. Stockton. Stockton has been through booms and busts before, but 2025 feels like deja vu of its darkest days. Back in 2008, Stockton was one of the first cities in America to implode during the foreclosure crisis. And now the same storm clouds are gathering again. The median home price sits around $445,000, which looks affordable compared to the Bay Area, but the real story is the crushing gap between wages and costs. Average household income hovers at $68,000, yet at a 7% interest rate. A mortgage on that $445,000 home demands monthly payments of nearly $3,200. Factor in $5,500 property taxes and $2,400 insurance premiums, and families are staring at $4,000 per month just to stay afloat. That's nearly 70% of local income, a ratio that's simply unsustainable. Inventory tells the next part of the nightmare. Active listings in Stockton have surged nearly 60% year over year, while pending sales have collapsed by over 30%. Homes that once sold in 20 days now sit unsold for 75 to 90 days, with sellers slashing $25,000 to $50,000 just to attract a single buyer. Foreclosures are quietly creeping back into the picture too, with distressed sales making up nearly 6% of the market, the highest level in a decade. Investors who once saw Stockton as a cash flow play are abandoning ship. Rents are stagnant at about $1,850 per month, but new buyers are shelling out nearly double that on mortgages. Negative cash flow is crushing small landlords, leading many to dump properties, flooding the market further. The most chilling part? Stockton sits in a high-risk zone for floods and wildfires, which is driving insurance costs higher and scaring off buyers. With Sacramento and Bay Area commuters pulling back due to remote work cuts and job losses, demand is evaporating. Stockton isn't just softening, it's teetering on the edge of another collapse, and history is whispering a brutal reminder. Once Stockton cracks, the ripple can spread fast across California. Number 5. Aliso Viejo. Aliso Viejo was designed to be a polished Orange County paradise, master-planned communities, manicured parks, and safe suburban streets. But in 2025, the dream is cracking under financial pressure. Median home prices hover around $1.15 million, yet even that number hides a disturbing truth. Homes that sold for $1.3 million in 2022 are now barely closing at $1.05 to $1.1 million. That's a 15 to 20% slide, and sellers are panicking. Nearly 40% of listings in Aliso Viejo have price cuts averaging $125,000, and inventory is piling up fast. The affordability crisis here is staggering. Average household income in Aliso Viejo sits at $130,000, but owning the median home costs a small fortune. A 7% mortgage pushes payments past $7,200 per month, and when you add $12,000 property taxes, $3,000 in insurance, and HOA dues often running $350 to $500 per month, the true carrying cost is closer to $8,000 every month. That's nearly 3/4 of the local income, an impossible equation. Families who stretched during the pandemic-era boom are now underwater, staring at ballooning monthly bills they simply can't manage. The rental scene offers no relief. Rents average $3,500 per month, leaving landlords who bought at peak with massive losses. Investors are rushing for the exits, dumping homes onto an already bloated market. Meanwhile, luxury buyers have disappeared, spooked by both affordability and rising insurance risks. Wildfire premiums in hillside neighborhoods have doubled, forcing families to swallow $4,000 plus insurance bills on top of their mortgage. The shocker? Aliso Viejo is showing cracks in its identity as one of Orange County's most stable suburban enclaves. Developers are stalling, open houses sit empty, and sellers whisper about cutting six-figure amounts just to get an offer. If current trends hold, Aliso Viejo could be staring at a 20 to 25% market correction, turning its master-planned dreamscape into a cautionary tale of suburban overreach. Number 4. Sacramento. Sacramento, once hailed as California's affordable capital and a pandemic migration hotspot, is now plunging into a brutal housing reversal. During 2020 to 2022, thousands of Bay Area refugees poured into Sacramento, driving median home prices from $375,000 to nearly $575,000 in a frenzy. But in 2025, the hangover is here. Prices are slipping fast, with the current median hovering near $500,000, down 12% year over year. Homes bought at the peak are already underwater, and the city's market is drowning in inventory. Active listings have exploded by nearly 55%, while closed sales are down 35%, leaving neighborhoods littered with unsold homes. The affordability nightmare is crushing local families. Sacramento's average household income is $82,000, but at today's rates, the monthly mortgage on a $500,000 home is nearly $3,600. Add $6,000 property taxes, $2,800 insurance, and rising utility bills, and families face $4,300 per month in housing costs. That's more than half of their income, pushing buyers away and leaving sellers stranded. Investors, once swarming Sacramento as a rental goldmine, are now bailing out. Average rents hover around $2,100, meaning landlords who bought recently are burning thousands each month. Vacancy rates are creeping higher as renters struggle with affordability, and eviction filings are rising. What's even more shocking is the reversal of Sacramento's pandemic-era growth story. Tech layoffs and return-to-office mandates have killed the commuter migration from the Bay Area. Builders who rushed to throw up subdivisions on Sacramento's outskirts are now stuck with rows of unsold homes, many already slashing prices by $50,000 to $100,000. Insurance hikes linked to wildfire risk are compounding the pain, with premiums doubling in some neighborhoods. Sacramento's housing boom was built on fragile foundations of cheap money and migration. With both gone, the collapse feels inevitable. The very city that promised affordable refuge is now at risk of becoming California's newest foreclosure capital, a shocking reversal that should terrify anyone holding a mortgage in the state's capital. Number 3. San Jose. San Jose, the crown jewel of Silicon Valley, has long been seen as untouchable. Home to tech giants, venture capital, and some of the highest-paying jobs in the nation, it was supposed to be recession-proof. But in 2025, that myth is shattering. The median home price still sits around an eye-watering $1.45 million, but cracks are showing everywhere. Sales volume has plunged nearly 40% year over year, and homes that once sold in days with bidding wars are now sitting for 60 to 90 days, many with price cuts exceeding $200,000. Nearly 1 in 3 listings have slashed asking prices, and the bleeding is accelerating. The affordability gap is staggering. Average household income in San Jose is a lofty $140,000, but it doesn't come close to what's needed. A $1.45 million home with a 7% mortgage rate demands monthly payments of nearly $9,000, plus $15,000 in property taxes and $3,500 in insurance. That pushes carrying costs to almost $10,500 per month, or $126,000 annually, almost the entirety of the local median income. Families are choking under the math, and buyers are walking away. Even the rental market, once a strong fallback, is collapsing under its own weight. Average rents are around $3,800, meaning landlords who bought recently are losing $3,000 to $4,000 per month just to hold onto their investment. Investors are dumping properties, and inventory is surging. Adding fuel to the fire are tech layoffs and stock market volatility. Thousands of workers who once fueled San Jose's housing boom have been laid off or seen stock options vanish. Without constant inflows of six-figure salaries, the housing pyramid begins to wobble. Developers, too, are feeling the sting, with large projects delayed or canceled as financing dries up. San Jose's housing market, once the envy of the nation, is teetering on the edge of a full-scale correction. With affordability shattered, demand evaporating, and job security collapsing, this Silicon Valley titan is no longer immune. It's a market in freefall. Number 2. Coto de Caza. Coto de Caza, one of Orange County's most exclusive gated communities, has always been a playground for the ultra-wealthy. Multi-million-dollar estates, golf courses, and security gates created a bubble of privilege. But in 2025, even the bubble is bursting. The median home price here is an astronomical $2.2 million, yet buyers have vanished, leaving luxury sellers slashing prices in desperation. Homes that commanded $2.5 to $3 million in 2022 are now sitting unsold for months, with reductions of $300,000 to $500,000 not uncommon. The affordability nightmare is on steroids here. To own a $2.2 million estate at today's 7% rates, buyers face monthly mortgage payments of nearly $14,000, plus $22,000 in property taxes, $5,000 insurance premiums, and HOA dues that often top $600 per month. Carrying costs soar past $16,500 per month, or nearly $200,000 per year. Even wealthy professionals balk at bleeding that much cash, especially with shaky stock markets and business slowdowns. Inventory in Coto de Caza has exploded by nearly 70% year over year, leaving rows of mansions unsold. Days on market averages have stretched past 120 days, with many homes lingering even longer. Sellers are quietly admitting they over-leveraged at peak pricing, and some are staring down potential foreclosures if buyers don't emerge soon. The luxury rental market is just as grim. High-end homes once leased for $9,000 to $10,000 per month now sit empty while landlords bleed thousands covering mortgages. Investors banking on appreciation are watching their equity evaporate in real time. The most shocking twist? Even this fortress of wealth isn't immune to wildfire insurance chaos. Premiums have doubled or tripled for hillside estates, pushing carrying costs into the stratosphere. What was once California's ultimate suburban dream is fast becoming a gilded trap where sellers slash millions off asking prices to escape. Number 1. Oakland. Oakland is ground zero for California's housing unraveling in 2025. The city's median home price sits around $780,000, but it's dropping faster than anywhere else in the Bay Area. Year over year, prices are down nearly 8%, and in some neighborhoods, losses are closer to 15%. Homes that sold for $900,000 in 2022 are now struggling to fetch $750,000, with sellers slashing $100,000 to $200,000 in desperate bids to move inventory. Nearly 40% of listings show reductions, and days on market have ballooned from 20 to 75 days. Affordability here is broken. The average household income in Oakland is around $95,000, but the true cost of ownership is suffocating. A mortgage on the median home costs $5,000 per month, plus $9,500 property taxes and $2,800 insurance. That's $6,700 monthly, swallowing more than 80% of local income. For many families, it's simply impossible. Investors are bailing at record speed. Rents hover around $2,900, but with mortgage payments double that, landlords are drowning. Eviction filings have spiked as tenants struggle, and vacancy rates are rising. Many small landlords are walking away, feeding a cycle of declining property values. Compounding the crisis are surging crime rates and insurance withdrawals. Some insurers have flat-out stopped writing policies in Oakland's highest-risk neighborhoods, forcing homeowners onto expensive state plans. Without affordable insurance, properties become nearly unsellable. The broader picture is even darker. Oakland's proximity to San Francisco was once its biggest strength, but with remote work fading and Bay Area job cuts mounting, the commuter advantage is gone. Families who fled San Francisco during the pandemic are now leaving Oakland altogether, dumping homes at fire sale prices. Oakland has become the clearest symbol of California's housing collapse. Falling prices, unlivable costs, surging inventory, and evaporating demand. What was once billed as the Bay Area's affordable alternative is now leading the charge into a freefall that could rival 2008.